Well, according to my next guest, the U.S. economy is aging in reverse. Here to explain that is Jared Franz, Capital Group senior economist. Jared, it's good to see you. So you described this economy as it's the Benjamin Button economy, Jared. I did not see the movie. I think I get the general concept, aging in reverse. Why, Jared, is this the Benjamin Button economy?
That's right. And so for those of you who haven't seen the movie, the main character played by Brad Pitt ages in reverse. So starts the movie as an old man and then ends the movie as a baby. And so why I think this is similar to the US economy and kind of an analogy for where we are. We look like we're late cycle, but instead of going actually into recession, we could actually be aging in reverse and going to mid-cycle. Now, if you look historically back at mid-cycles, those can last in the post-World War II period up to 5 years. So this could be a great time for investors to think about long-term investments.
But how did this happen, Jared? If you're right, and this is an aging in reverse economy, why?
The main reason is the labor market. So the post-pandemic labor market is very different than it was pre-pandemic. And so we see labor markets that have excess demand relative to supply. That's persisted even 4 years after the pandemic has happened. We think that's going to continue to happen into 2025. So if the labor market stays resilient, wages stay at 3.5%, unemployment rates stay between 4 and 4.5%, and we have job growth, you net that out, that's a good income setup, which drives spending. So that's the reason why. It really goes back to the labor market and how it's changed post-pandemic.
And so if you're right in this analysis, Jared, it means what? Not just for 2025 and beyond. What would be the implications?
The biggest implication is that this could be a longer cycle than people expect. So if you look at mid-cycles, again, they go 3 to 5 years, let's say, and if this mid-cycle goes that far, then you add a late cycle onto that. And so we could be looking at more like a 30 type recession, something that's very far off. And so we want to keep invested, keep that long-term strategy in place and stay invested, really. That's the idea. So
if you're right about the macro, about the economy, it's good news. Your point is for the stock market. Can we get even more granular? Can we go under the hood of the stock market? Where would I want to be positioned?
Regardless of what's happening with interest rates, one of the biggest places you can be positioned is really in AI, artificial intelligence. And that's something we've been doing at Capital Group for some time. We've been looking at it for almost 10 years now. And so the first phase was neural networks. The latest phase is LLMs. And so as you think about the long term, we're really bullish about where AI could be in the long run. And so we're constructive on the big hyperscalers, but also on power companies, utility companies. There's a lot of benefit that can come from those for those who stay invested, of course.
Let's end here with a question about Washington, Jared. Obviously, Trump has moved back into the White House. There is a tremendous amount of uncertainty about fiscal policy, right, when it comes to how that's going to play out, taxes, tariffs, regulation, immigration. And we had the Fed meeting yesterday at the presser. Jay Powell even talked about that uncertainty, right? I think he kind of likened it to sort of driving in the fog. All that uncertainty, Jared, how does that impact, how does that play into your forecast for the economy, if at all?
When we look back at the press conference yesterday, the FOMC made a couple big changes. One is to inflation and one is to interest rates. The big change in inflation was to raise their inflation forecast to something more like 2.5% for next year. That was a big change. And as a result, what they've also done is with their interest rate forecast, raise that as well. So as we think about what's going to happen going forward, that's not something that we're expecting that in our base case view, that we're going to have higher rates for longer. And the terminal rate could be closer to something like 4%. So that's not a surprise to us. Now, we'll see what happens with the administration. We're keeping our options open, and it's really one of those cases of having to see what actually is in legislation. It's hard to look at where we're at right now and not have anything on paper to really have an expectation. But if you look back historically, the U.S. economy can operate at a higher interest rate environment, can operate at a higher inflationary environment. And again, it just goes back to the resilience of the U.S. economy that if we're aging in reverse, going back from late cycle to mid cycle, you don't want to miss opportunities here.
The Benjamin Button economy. Jared, thanks so much for your time, your insight. Appreciate it.
Thank you.